Hello, and welcome to Virtual Investor Conferences. My name is Laura Hamilton, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Bank of San Francisco. Before I introduce our speakers, please note to submit your questions in the question box to the left of the slides. And all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Wendy Ross, President, Founder, and Director of Bank of San Francisco, which trades on the OTCQX Best Market under the symbol BSFO. Welcome, Wendy.
Oh, thank you. Hello, everyone. First, I want to say how very pleased we are to be with you today. We first presented at last year's two OTCQX Bank Investor Conferences, and it's a real honor for us to be back today. Joining me today are Ed Obuchowski, CEO, co-founder, and director, Jennifer Kaur, our CFO, and Felix Miranda, head of commercial banking. Today, we very much look forward to sharing with you the Bank of San Francisco story and to provide an update on the performance of our bank, as well as a few of the key ways we are differentiating ourselves in the market, especially related to deposits. Before we get started, I'd like to direct you to our forward-looking statements and non-GAAP disclosures. The next slide highlights the topics that we'll be covering today. As some background, Ed and I are two of the 11 founding employees of our bank, which we started in 2005. It's interesting that we were the first bank to open in San Francisco in almost 20 years. Two banks, Presidio Bank and New Resource Bank, opened within a couple of years of our founding, but have since been acquired. So at this point, we're in the unique position of being the only broadly owned community bank headquartered in San Francisco and serving clients throughout the greater Bay Area. When we started the bank, Capital Bancorp, headquartered in Lansing, Michigan, was our majority shareholder. Some of you may remember Capital Bancorp and the significant financial pressure it was under during the Great Recession. To give you an idea of our team's determination and our bank's culture, we were one of only 3 of the approximately 64 Capital Bancorp banks that succeeded in buying out its 51% ownership in our bank. And we accomplished that in 2010, a time when you probably remember banks weren't all that popular. This was a true grassroots effort, with the investors being our employees, directors, many of our clients, as well as other family members and friends of the bank. Today, to the best of our knowledge, we have 5 institutional investors who together own approximately 36% of our bank. Our employees and directors own approximately 17%. And Ed and his wife are actually the largest individual shareholders, and my husband and I are within the top 10. So you can see that with this kind of personal financial commitment, our interests are aligned with those of all of our shareholders. Since the start of our bank, we've been believers in investing in technology instead of in an extensive branch network. With that strategy, we offer our clients robust online and digital banking solutions for their day-to-day banking needs, coupled with highly experienced relationship managers who are available to them 24/7. Our only full branch is in our San Francisco head office. However, we do maintain a loan production office in Walnut Creek, which is about 25 miles east of San Francisco and a key geographical market for us. As a community bank, we have a very broad industry representation in our client base with no significant concentrations. Our clients include small businesses, professional service firms, contractors, fiduciaries, medical and dental practices, nonprofits, municipalities, families, and individuals. We don't bank crypto, cannabis, or money services businesses. One of the absolute key strengths of our bank is our executive team. Over the past several years, we've made a concerted effort to develop the next generation of leaders. Almost all of our leadership team received excellent technical training at the major money center banks where they worked in the early years of their careers. And then in working at our bank, they have meshed those strong technical skills with the culture and values of a traditional community bank. Jennifer Core, our CFO, who will be presenting next, is the one exception to the rest of the teams having been career bankers. Jennifer was actually an audit partner at the CPA firm BDO prior to joining us in 2019. During her career in public accounting, Jennifer worked both with some of the largest and the smallest banks in the U.S. and worked with those banks in both booming and challenging economic times. With her experience in public accounting, Jennifer has brought a very helpful perspective and area of expertise to the team. You'll hear more on our financials from Jennifer, but quickly you'll see from the next 3 slides that our assets were $591 million as of the end of 2022. You'll note that our loans and total assets grew substantially in 2020 due to our very active involvement with the Paycheck Protection Program. We actually originated 929 PPP loans totaling $259 million. That was an extremely high level for a bank of our size and reflected the team's strong commitment to helping our community at a pretty dire time for so many. I want to point out that our heavy involvement with PPP loans also led to a spike in our profitability in 2021 and to a number of significant long-term client relationships that we would not have had it not been for our team stepping up to help those clients win their PPP loans. Now I'd like to turn the presentation over to Jennifer, who will go over financial highlights and liquidity. Jennifer?
Thank you, Wendy. I would like to remind everyone that the press release highlighting our year-end 2022 results are posted on our financial website under Investor Relations tab, as well as on our OTC market profile. As a lot has happened in the last few weeks in the banking industry, I will comment on just a few year-end results and focus on some of the hot topics in the current environment, such as liquidity and interest rate risk. As Wendy noted, we had a large number of PPP loans in 2020, as previously noted in our 2020 and 2021 various press releases. However, you can see the growth of our non-PPP loan activity has continued at 13% in 2022. We decreased our broker and public funds at the end of the year by $17 million from prior year, and I will touch on liquidity in March shortly. Relationship deposits remained relatively flat for the year with a small decrease of $3 million. Net income decreased from the prior year, primarily related to the allowance for loan loss provision recorded in 2022. As you can see in this slide, we have continuously grown our non-PPP interest income every year. In 2021, we had PPP interest income of $5.6 million, which decreased to $1.4 million in 2022, or a $3.2 million decrease of PPP interest income. However, our non-PPP interest income increased $4.4 million, replacing the non-recurring PPP interest income from the prior year. The combination of loan growth and resetting variable rate loans resulted in the increase of non-PPP interest income. Our diluted earnings per share have steadily increased over the years, with 2021 standing out from the large PPP activity and no loan loss provisioning during that year. There has been great uncertainty in the banking industry over the past few weeks, so I'd like to highlight our conservative approach and liquidity position at the end of last week. As noted in the overview, we do not hold an investment portfolio. As such, we have not been impacted by the decreasing values on investment portfolios some banks have incurred. Additionally, we hold a minimum of 10% of on-balance sheet cash and have borrowing lines available totaling more than $200 million. Our unsecured or uncollateralized deposit balance over the FDIC limit is approximately 38% of the total deposit balance as of February 28, 2023. We have historically taken a conservative approach to balance sheet management, and while we could have reached for yields in prior years when there was an excess of liquidity, we decided to stay true to our core banking fundamentals on managing balance sheet risk. Now I'll turn it over to Felix for a discussion over our continued deposit focus, commercial banking highlights, and the commercial variable versus fixed rate portfolio metrics.
Thank you, Jennifer. With all of the focus on banks' liquidity in the market today, I wanted to spend a few minutes talking about our deposit portfolio. We have a very well-diversified deposit base consistent with traditional community banking. Our clients include small businesses, professional services, and nonprofit organizations. I'd like to highlight a few client segments that we have particularly focus on. Community benefit districts are neighborhood organizations common to San Francisco. These quasi-municipal organizations have very stable and recurring deposits derived from city-collected property tax assessments. We've developed a great network with these organizations and provide them with a full complement of cash management and deposit services. Political campaign treasurer, consultant, and attorney accounts are another client base that we have an expertise in. These clients also require our full complement of cash management and deposit services and maintain significant deposit balances throughout the year. With the overlapping political cycles of local, state, and federal campaigns, seasonality of these deposits is limited. Other deposit clients include nonprofit organizations, labor unions, and homeowners associations. The next slide shows the comparison of our deposit portfolio by account type. Now, as you can see, the largest portion of our deposit resides in our non-interest-bearing demand deposit accounts. 46% of our total deposits are in demand deposit accounts, which are typically our small business clients' operating accounts. The next largest account type is our money markets, which represents 27% of our total deposits. And this is typically our clients' excess cash above what they need for their daily operating cash. CDs represents 20% of our deposits. And although this segment has grown somewhat as rates have increased, almost all of these are less than 12 months in duration. Our overall deposit cost of funds was 0.62% at year end. Our commercial banking loan portfolio is comprised primarily of small business and middle market clients located throughout the 9 Bay Area counties. As with most community banks, we focus on traditional C&I business, such as professional service firms, contractors, and food service businesses. We feel one of our competitive advantages is our ability to provide sophisticated credit structures to our small business clients. Our experienced relationship managers offer creative structures, combining conventional and government-guaranteed loan products to provide the most flexibility and options for our clients. We also provide a full suite of cash management products, online and mobile banking, and local client support for our clients. Commercial loans represent approximately 50% of the bank's total credit portfolio. Of this, 30% of our portfolio is commercial real estate and multifamily loans. These are comprised of owner-occupied real estate loans or small business C&I clients, to our small business C&I clients, and small multifamily properties to our real estate investors. Approximately 15% of our portfolio is traditional C&I loans and lines of credits to our small business clients. This includes our SBA 7A loans. The overall yield on our loan portfolio was 4.67% at year end. The next set of slides illustrate the fixed rate exposure in our loan portfolio. Our commercial loan portfolio is comprised of traditional community banking small business loans, such as lines of credit, term loans, and SBA 7A loans. 47% of these loans are variable rate loans. Another 30% are fixed rate loans repricing or paying off within 3 years. Only 23% of these loans have a fixed rate longer than 3 years and are typically fully amortizing term loans. The yield on our C&I portfolio was 6.07% at year end. Our commercial real estate loan portfolio also has a limited amount of long-term interest rate exposure. Generally, our investor real estate loans are comprised of multifamily properties with 5-year fixed rate loans. Only 14% of this portfolio has a fixed rate longer than 5 years. The overall yield on this portfolio was 5.90% at year end. Now I'll pass it over to Jennifer to discuss the residential loan portfolio.
Thank you, Felix. I will touch briefly on our residential interest rate risk. The residential products in our portfolio are 3, 5, and 7-year ARMs predominantly, with the loans transitioning to a variable rate after the fixed period. While the loan terms are 30 years, our historical experience is a borrower will either refinance the loan at the end of the fixed rate at the current market rate, or the loan has already been repaid through the sale of the property. Loans transitioning to variable rates at the end of the ARM period is uncommon. As you can see, our interest rate duration risk is longer in the residential portfolio compared to the commercial portfolio. However, these loans tend to have a lifespan of around 6 years, as this portfolio turns over faster than the typical 30-year fixed-rate mortgage portfolio. Now, I'll turn it over to Ed for some closing thoughts, and then we'll go to audience questions.
Thank you, Jennifer. We're so pleased that you chose to join us today, and grateful to have been able to share some of our insights with you. If you'd like to schedule a meeting with our team in the future, please reach out to Leslie Catter, our head of marketing and investor relations, at leslie.catter@bankbsf.com. Now I'd like to open up the floor to any questions that you may have. And again, thanks for joining us today.
Thank you, Ed. We do have a number of questions in the queue, so I'm going to start off with the first one that is discussing the bank's office commercial real estate exposure in downtown San Francisco. Wanted to know what risk there is to the bank in that portfolio.
Yeah, thank you. No, as a classic community bank, we certainly don't have any exposure to large Class A office buildings in the city. In the central business district, we have one loan totaling approximately $2 million, and that has a loan to value of under 10%. So we certainly feel very comfortable with the risk profile there. In the neighborhoods of San Francisco, including the Mission District, Pacific Heights, Russian Hill, we have 3 loans totaling approximately $16 million. And the combined loan to value ratio on those is about 40%. So again, we feel comfortable with the risk profile. And I also want to note that all of these loans are current, and the borrowers are all long-standing clients of Bank of San Francisco.
Thank you, Ed.
Thank you, Jennifer.
I have 2 questions that I'm going to pair together, so bear with me for a minute. One is looking at the loan to value around the CRE portfolio, and then also talking about as interest rates tick up, there's welcome relief on our margin. However, do we see a downside for the banks if the rates remain high? And if so, what is the bank doing to mitigate, which I think ties into some of our underwriting that we're looking at in the loan to value on our commercial and residential loans.
Sure. Why don't I start?
Yeah,
go ahead. Go ahead, Jennifer. Was there more to the question?
Just the question. Sorry, the question around the loan to value and then how we look at it in our underwriting policies going forward.
Sure. And we actually amended our underwriting policies even dating back to last year, first on the residential portfolio. Um, in the last time we did an analysis of the entire portfolio, the weighted average LTV was in the low 60% range. The weighted average FICO score was 789, I believe. And all loans are current with the exception of one of 200,000 where the borrower is now deceased, but it's a very low loan to value. And I'm sure we don't see any loss potential on that one. The commercial portfolio itself, we have reduced our maximum LTV in our underwriting, but also with rising rates, and then a number of ours reset our variable rate loans or maybe like a 3-1 ARM type product. Those interest rates reset. And so we sensitize our underwriting, adding 1 or 2%, depending on what market conditions are, to our base underwriting standards to be within our policy limits. I'm just pleased with how current our portfolio is. And also, we as a bank have established a discipline we've had throughout our history, but the frequency increased at the beginning of the pandemic, where we have quarterly portfolio reviews with each of our relationship managers. And the 4 members of the management loan committee meet with them for up to 30 minutes to an hour each, going over the ones that we see potential risk in and how they would withstand a rising rate environment. So we feel we absolutely do have our finger on the pulse and just feel comfortable with where we are. It's a dynamic environment, so we remain vigilant. It's just vital to our long-term success. Felix or Wendy, I'm not sure if you have anything you'd like to add on just related to LTVs or commercial real estate portfolio and our residential portfolio as well.
Yeah, I actually have just one comment to add on the leverage on the commercial real estate portfolio. So, as rates have gone up, the cash flow becomes tighter for these clients. So it effectively pushes the leverage and the LTV down on new loans that we originate. So we underwrite to cash flow on all our commercial deals, and generally the cash flow supports a loan to value that is much lower than our policy already. So as increases in rates, rates continue to increase. Effectively, our leverage comes down on new commercial real estate that we originate. So we're always focused on cash flow.
At the end of the day, we're cash flow lenders. The real estate is secondary source of repayment, a potential mitigant, but the primary focus in our underwriting is always on the ability to repay, whether it's on a commercial real estate loan, a C&I loan, or a residential real estate loan. All of us were classically trained at the big banks of America, and we've applied those disciplines to Bank of San Francisco in our bank's 17-year history. Thanks for the excellent
Thank
question.
you, gentlemen. Yes, we do have another question that came in around the additional provisioning and charge-off that happened at the end of Q4 of 2022, and just giving some more context, and if we have any exposure related to that real estate service industry as
Sure. Yeah,
future exposure.
I'll do that. So last year we did indeed charge off in the fourth quarter $3.9 million, and it was related to 2 different loans, both in the real estate brokerage industry. One was a residential real estate brokerage company. The other was a residential real estate title insurance brokerage company. There was a common guarantor on both of those. We don't have any other similarly situated loans in our portfolio. Both of these businesses suffered with a significant volume decrease in residential sales in the California market last year. And so that was the key driving factor on that. And I would like to know that that was certainly very out of pattern with what our bank's historical credit performance has been. Until these 2 charge-offs, our cumulative net loan losses throughout our bank's history was a little under $750,000. So, this is a year where we're back to basics, very much focused on borrowers' ability to repay, looking at what potential loss in the event of a default was, all those important elements we have to do in managing a commercial portfolio.
And we might just want to add that just given the economic environment and the interest rate environment and turmoil in the industry, we have definitely tempered our growth expectations for this year. Now, this is a year, as Ed said, back to basics, just, old-fashioned, good, traditional community banking.
Yeah. No, for those of you who've been following our bank over the years, up until 2021, we were averaging approximately 20% annualized growth in relationship deposits, loans, and overall assets. Last year, we were flat. I think we were marginally down for the year. This year, as Wendy said, we are tempering our growth. We're not going to do anything unnatural in the current operating environment, but where there is opportunity for quality relationships, certainly we've got the capital, we've got the funding sources for that. We continue to be opportunistic, but we are cautious as well. Now is not the time to stretch.
And on that note, I'm going to circle into a couple questions that we had around the opportunity that presents itself with what's going on in the market with some of our competitor banks here in the Bay Area. And then also focusing on asking what is deposit balances and what we've seen so far in March compared to year end. I will touch briefly on our deposit balances from March compared to year end. We do historically see a decline in Q1 deposit balances from our customers. That is just a normal process that you will see in our previous financial statements. We have not seen a decline. It's relatively flat compared to where we were at year end. And then I'm going to turn it over to Felix and Ed to talk about the opportunities with some of the items that we're seeing with the turmoil in the market.
I guess I'll start on that one. I would say we have seen, I'd say some inflow of deposits over the last few weeks, just with some turmoil in the market, primarily from our existing clients who had funds held at different institutions, where they felt more comfortable holding those deposits with us. We have had a couple of opportunities with new clients, not an overwhelmingly amount, but we have had a couple of opportunities with new clients opening accounts from other institutions, primarily through referrals from existing clients. They had a partner or someone who was concerned about their deposits at their other institution. They moved funds over to us. And then I think we've done an effective job of communicating to our clients about not only the safety of our bank, but how FDIC insurance works, what type of insured products are out in the market, and really what the difference between our institution is and other institutions that have been under more deposit pressure. So I think there is opportunity out there. We're really primarily focusing on our existing clients and getting a bigger share of their deposits if possible, and kind of referred new business in through clients and prospects that we've had on our radar for some time. And Ed, Wendy, anything else to add on that?
Yeah, just a couple things. First, thank you, Felix. Historically, we've competed far more with First Republic than we have with Silicon Valley Bank. Silicon Valley Bank has a very different profile in its client base. First Republic is a highly respected competitor, and when we would be pursuing opportunities in the nonprofit community, they were very often a rival of ours. I do think things will have fundamentally changed at First Republic now. I don't think it can be the low-priced leader in its loan portfolio of paying premium deposits when we've seen such a big exodus of their non-FDIC insured deposits and all. So, we're visiting those, nonprofits and other businesses that we've pursued in the past, where we may have lost out to a First Republic. So, we differentiate ourselves by being San Francisco's neighborhood community bank. We're in an urban environment, but we have the traditional values of the best community banks in America, and that's a referral-based business model. So we're dealing with people that we know and trust. We have long tenured client relationships. We have long tenured employee and client relationship. And also, we're a very diversified bank. For a bank of approximately 600 million in assets, there's much greater diversity in this bank than some of those other banks that have struggled in this environment. So, we've stayed away from the bright, shiny objects like crypto and other ones. We stick to our basics, and
And
slow and
thank you,
steady
Ed. I
wins the
think we're running up to the end. So any final thoughts, and we'll wrap it up?
I do want to set realistic expectations. Given what's going on in the market nationwide and all, I do think our net interest margin has peaked. I think that's pretty much in line with most other banks in the country. Um, and again, a continued ongoing focus on relationship deposits, seizing opportunities with the market turmoil, and staying vigilant on our loan portfolio. Wendy, any final comments?
Those are the goals for this year. And our entire bank of 48 people, we're all focused on those areas.
Yeah.
And we're, as we mentioned earlier, we're a very determined group and a very committed team. We're just so proud of our team for what they're doing, and especially during this time of kind of uncertainty and a little bit of turmoil in the industry.
Yeah.
All right,
Jennifer,
I
any
think that
final questions?
concludes.
I'm not sure. Do we have time?